So Eduardo already showed his expertise by his questions, but I would still like to introduce him. He is the managing partner of InterChina, which is a boutique M&A advisory firm established in 1994, which has been involved in 160 cross-border transactions with an accumulated investment of 7 billion euro. He has been living and working in China for over 14 years, focusing on M&A and investment projects. He has expertise in corporate transactions, joint venture formation, buyout structure, mergers and acquisition transactions, senior level negotiations, and has also been lead negotiator in more than 40 transactions in the past year. I also had the pleasure to work with him on the executive committee and the board of directors of the European Chamber, so I'm very glad to have Eduardo here with us today to talk to us about China-Europe M&A. Eduardo, the microphone is yours.
Thank you very much for this very kind introduction. Also, thanks to FTE for inviting me today to share with you our experience, and we've been cooperating with FTE for a while, and I think that they are now tapping into a very interesting investment flow that, in my view, is going to shape up the global dynamics of global cross-border M&A, which is basically outbound. And that's the topic I've been invited to talk about, specifically outbound, Chinese outbound into Europe, and specifically into Germany. This is all basically coming from the, I would say, recent transactions we've been doing in the past. So, myself, I've been already introduced. Now, the company I work for, and I'm one of the equity partners and the managing director, is InterChina. InterChina has been in the Chinese market active as an investment bank for more than 22 years. We are around 60 people based in Beijing, Shanghai, and we have a small London office. We are part of a company called Clearwater International, which is a mid-market European and North American investment bank with around 200 people. I think that I would say 80% of what we do now is still inbound investment. And I think that most of our clients are multinationals who are very aggressively doing M&A, joint ventures, restructuring, being part of the consolidation of the Chinese market. So I think that that's basically business as usual. Now, what is new is how in the past, I would say 3 or 4 years, 20% of our deals have moved aggressively into outbound. When we talk about outbound, for us, our strategy has been very clear. We don't work with state-owned companies. We don't work with non-listed companies. We are only working with listed cos, private listed cos. That doesn't mean that this is the leaders of the outbound flow. I think that actually the leaders of the outbound flow are Chinese state-owned companies, but our experience of working as a service provider with them is pretty bad. I mean, they are still don't engage professional advisors in a very, I would say, mutually beneficiary way. So they are also very bad at payments and delayed payments and all that, and there is lots of politics around. So we don't work with these guys, and we are basically working with privately listed companies. Now, most of the deals that we are doing, we've been doing basically every year 2 or 3 transactions. Most of them, they are mid-market. I would say between $50 to $300 million. Last year, we closed a very big deal in the USA that was $1.2 billion. That was the acquisition of Joyson Electronics to KKS. That was the largest automotive component deal by China in the history. But most of our deals are with different clients that have a different background. I would say, yeah, average 150 million. So we've been representing buyers. We also been representing sellers. Every year we have maybe around 10 sell-side mandates coming from family-owned or private equity companies from Europe and the USA that we believe have a Chinese angle. So I would like to give you my views and my experience, not of what has been happening, but of what's going to happen in this outbound field. And the first thing is that, in my view, after the 2017 Forex control measures, I mean, we all know about this. Basically, last year, outbound was booming. It was, almost 40% higher than inbound deals. And a lot of money went out of China. China lost $1 trillion of its 4 trillion reserves. The Chinese government got very, very, I could say, afraid and concerned about this uncontrolled flow, and they decided to control it through Forex, basically measures. So now, by this time of the year, I just look at the statistics, outbound flow has gone down dramatically, 68% down. And most of the deals that are either very big or real estate deals that doesn't have any connection to China, or deals that are speculative, or deals conducted by a company doing shoes and they want to buy robotics, all these transactions now, they are being seriously controlled or even stopped by the Chinese government. So I think that next year to come, I just had a meeting with NDRC officials last week, asking them what can be expected about consolidation in China and outbound investment. And the guy told me, we are going to continue encouraging outbound investment, but smaller transactions, so we like mid-market. Number two, technology transactions, so we will judge every deal done in Europe, on the USA or whatever. I'm talking about Western world. This is not Silk Road or Africa or Latin America. This is basically OCDE investments. So we will be taking a look at what this deal can bring back to China. So we're going to encourage technology deals. We're going to encourage pharma. We're going to encourage food that brings value to our middle class. So in a sense, the government is going to look at what China is importing now and whether that acquisition can help to integrate that value into the Chinese state. So that was very clear. And the guy told me, unless the group has money in Hong Kong or Singapore, and by the way, we're going to be controlling a lot the establishment of SPV companies, special purpose vehicles, by Chinese entities into Hong Kong and Singapore. So unless these companies have money already out of China, we are going to be disencouraging investments on real estate, opportunistic or speculative investments. The guy told me that they were very worried about money laundering and all these issues. So in my view, if I look at the pipeline of what we are doing now, I think this is what you could expect for the at least next 2 years to come. 60% will be corporate transactions. And again, I'm not talking about Silk Road, I'm not talking about infrastructure or energy or whatever. I'm talking about OCDE, outbound investments, especially in Europe. So 60% will be corporate, basically mid-market, between 100 to 1 billion euro, and when I say 1 billion, I'm already being very optimistic. I think that the sweet spot for China is going to be 1 to 200 million euro. Profitable, and by profitable, I don't mean EBITDA profitable. I think that the Chinese government will not approve EBITDA profitable companies who are not profitable by net earnings. And by the way, there are a lot of these companies in Europe now because they are being acquired by private equity, they are being acquired by a lot of loans, and basically they are EBITDA profitable, but they are losing money because of interest loans. So I think that it will be, let's call it net profitable, and in auto, machinery, special vehicles, retail, food and beverage, and financial. I think that will be 60. Then, sorry, this is a typo. I think that this will be less, actually. Real estate will be going down dramatically, so I think it's going to be around 15%. And I think that that's going to be basically still managed by those companies who have already Hong Kong vehicles. I don't think that you will see a lot of fresh money coming from China into Europe directly. So companies like Sino Ocean Trust and all these kind of big companies who have maybe $1 or $2 billion already in Hong Kong, we will see a lot of that, going especially into real estate and good, I would say, IRR profitable projects in Europe. And then others, which things like, for example, art. I think this is going to be a big bump of investment of Chinese family funds and Chinese investors into art exhibitions, big collections, wineries. That's still going to be very focused investments in a way to put their money away from China. So I think that's basically how I see it coming. We've been talking last year with around 90 shareholders of Chinese companies, and what they told us, what they wanted to invest, I think is very straightforward. So just like electric vehicle, driving assistance systems, automation, high-end manufacturing, robotics, aerospace, biochemicals, healthcare, brands, and all that. So this is exactly the requirement. When we are being sit down with a Chinese investor, they say, we want to buy this. And basically what they told us is before this buying request, they are negotiating with the Chinese government officials and the Chinese banks who are going to transfer the money about this. And if you look at this is basically China 2025. This is what it was published by the Chinese government on the revamp of the Chinese industry. This is what the Chinese government is encouraging to acquire. So I think that now we're going to see a big alignment between the outbound investment of Chinese investors and the state goals. And this is actually confirmed by the latest Chinese outbound transactions in the last six months. I mean, this is very small. You can have this presentation, by the way. Probably you cannot read it, but it's companies about automotive, engineering, electronics, energy, food, automotive, and all that. So that's already taking place on most of the latest transactions, especially for Germany. Now, one would ask, is it a good moment for a Chinese company to buy into Europe? And I think that the reply is pretty good. If you look at the performance of Europe, and you can look at political risk or country risk from many perspectives. I like to look at the stock market because in Europe the stock market really reflects the fundamentals. It's not like in China that it's more like a casino with lots of speculation and much detachment of the real performance of the country. In Europe, it's very stable. And if you see from, let's call it 2012 until 2017, you can see that the market has been reflecting all the crises, like the Greek crisis, the Ukraine crisis, the another Greek crisis, the Brexit crisis, and the Trump presidential referendum crisis. So every time the market goes down, but then it recovers very quickly. And over all these crises, there has been a very stable upwards investment on the EBITDA valuation of all these listed companies, So I think that Europe probably is a very stable place to grow. And the question, like any good investor, you need to buy whenever the prices are down. And we are facing 2 years of downwards prices. Why? Well, first, because of the political tensions in Europe. There is a lot of increasing populism. You know that. Second, still the Brexit. It's going to be 2 years of uncertainty. Catalonia. I'm from Spain. I mean, I can tell you about that. It's a big crisis for Spain, but also for Europe. And also all the immigrant crisis and all this Islam and all these issues. That's creating a lot of uncertainty in Europe now, and it's making many of the European funds and companies to be more conservative, which means that there is a window of opportunity for Chinese investors to buy at lower multiples. And you will see the multiples are, I wouldn't say cheap, but they are relatively more attractive. And we know that this is going to pass, and then you will have a company there, ideally in a well-performing area. Now, this is already being reflected. All this crisis and all this turmoil in Europe, if you see in the past years, 2015, 16, and 17, the number of outbound deals, let's call it inbound deals, from the rest of the world into Europe has been dealing and driving the M&A landscape in Europe versus domestic or outbound transactions. So this is already a well-consolidated trend. People is investing in Europe because it's a good time. Now, just very quickly for those of you that don't understand how is the European landscape. So when you are doing M&A or investment, you have sellers and buyers, is that right? So the sellers next year are going to be basically private equity and then a combination of strategic partners, mostly driven by family-owned companies. Now, private equity in Europe is not like in China. In China, you have a lot of minority stakes. But in Europe, most private equity companies, they are taking control. And there is now just a round of companies that are reaching 5 to 6 years on the portfolio of European private equities that are going to be put on the market next year and the year to come. So we are foreseeing a big bump of private equity transactions that will be mostly mid-market. And then strategic players, you have big multinationals. We know there are going to be some strategic sellouts, like people restructuring, refocusing and all that, but the big issue is going to be about small and medium-sized enterprises. So we're talking about a typical company that could be on sale next year, would be a 100 million euro, family-owned, Germany-based, a 100-old company doing pumps or hydraulic components, for example. So I think that these are going to be basically the sellers. And the expectations, the forecast that we are seeing is that next year is going to be a seller's market. It's going to be a seller's market. So there's going to be affluence of transactions on the pipeline. We already see that on our own pipeline. And who's going to be the buyers? Well, the buyers are going to be basically private equity and big multinationals. I'm talking about the competition. If you guys are looking to acquire a European company, most probably you will be competing with a local private equity or a multinational company, mostly from USA or Japan. They are heavily investing now, also some Indian companies. They're heavily investing now on Europe. And now, if you look at the EBITDA multiples that private equity are paying, you see that they are paying now an average of 9.2 EBITDA, while multinationals are paying 8.4 to 8.9. So we see a price war going on between private equity and multinational companies because actually there are not so many good targets. So everybody wants to acquire the good company and put it there. So basically what I'm telling here is that if you are thinking about buying in Europe, you should be ready to react on a competitive landscape. And some of these people are very aggressive, especially private equity. Now, just a little bit of valuation. I think that Frederic asked me to give you an idea on what could be the values for next year. In our view, for industrials and automotive, which I think is going to be a lot of Chinese transactions in Europe, we're talking about 7 to 12 EBITDA. Now, in China, to buy an auto company, you are paying now between 10 to 13 EBITDA. So actually the gap is narrowing down. Yeah, anyway, if you go to mechatronics, it will be more expensive. If you go to stamping, it will be less expensive. But I think that would be the range. And then in other areas, you know, healthcare, food, consumers, the average is 10 times EBITDA, so it's pretty expensive. Still, if you're raising money in the Shanghai Stock Exchange with a PE ratio of 40, this is a very valuable transaction. I mean, you make a lot of money with this. Now, these are some of the transactions that we see coming next year. So these are transactions that we are going to put on the market in China next year. I just wanted to, of course, without names and all that, but I wanted to give you a feeling of what's available and what Chinese are going to be buying. So the first one is a hydraulics. I think there is going to be a lot of hydraulic transactions going out, leading by Chinese companies. So this is a typical company, like a 100 million euro, and I think that this is going to be around 5 million euro EBITDA company, owned by a private equity. They dump a lot of cash in terms of loans, so it has a very high leverage and is net earning negative. And I think that this is the typical company that could be acquired by a multiple of 12 or 13, you know? And you're bringing a lot of, you're bringing global technologies back to China, so the government is going to support this. Another company, valves, hydrants, and water flow. I think China is going to invest a lot on this field because now they are importing most of these products from Europe and the USA. Again, this is a average medium size, like 230 million RMB, euro company, profitable, 4 million net profits. And it's a company that has a global technologies, patents, and all that coming from Germany. And this is owned by financial investors, but it's basically a family. It's a fund that they want to divest and basically cash out because there are 5 people who are fighting for this. Now, electronics, again, 80 million profitable. Mechatronics for automotive, electric vehicle, companies with extended portfolio of technologies. Yeah. So I think that these are typical deals that the Chinese are going to be investing into, and the typical transaction that we think is going to be supported by the government. Now, very quickly, there was a publication this year that basically said, is by a Chinese institute, that say that around 70% of the Chinese bids, 70% failed on the global markets. That means that when Chinese companies go to an auction and they compete with USA, Europe, Japan investors, they most times don't win the contest. We have been actually suffering that. And I think that's part of the situation of outbound. There is still on an early stage for many Chinese companies the first time they do it. So I just would like to share with you our view on this. I will do it very quickly. So I think that many people complain that the Chinese bids have a very poor strategic fit. So when you are making a bid on the bid documents, or even if it's a private one-to-one discussion, the seller is going to ask you, why do you want to buy me? What do you want to do with my company? Most of these companies are owned by family members. It's his baby. He wants to make sure that the company has a future, you know? And many Chinese companies, they just don't provide a convincing reply. They don't have a synergy map. They don't have a rationale to explain this. And they say, well, I just buy it. I give you the money. It's not your problem anymore. It will be my problem. And that's not good enough. People want to know whether you are a serious buyer, and they will look at your strategic fit. Then, overly optimistic estimates. I think that on average, a European banker was telling me that on their auctions, Chinese people overbid by 25% on average. That's crazy. I mean, why would Chinese have to overpay 25% to win, you know? And usually it's because there is an inadequate due diligence or integration planning analysis. So I think that many of these companies, they have a lot of cash, they don't have a proper process, and this overbidding is having a big impact on the flow. Of course, the seller is going to be very happy to get that money, but the government now, the Chinese government, is looking at valuations and is trying to block overpaid deals. So I think that that's an issue of approvals. And then inability to execute quickly and efficiently on the process. Like we are now on a transaction where we are competing to acquire a US plant on paper. It's a $600 million deal. And our client is taking 1 month to sign an NDA. So that's because the NDA has to be approved. It's a bilingual document, has to be approved by different bureaus and departments. It's crazy. It's a state-owned company. And I think that it's very complicated. You know, so that's an example. Many companies have to get approvals to do due diligence in Germany, whatever. I think there is a lot of issues about process that has to be regarded important, you know. And now, this is a survey we conducted among Western sellers and lawyers about Chinese investors. So we were asking them, how do you perceive a Chinese bid when you have a Chinese company who want to acquire? What is your, you know, are you happy? Are you unhappy? So I think that it's very important that Chinese investors know how they are perceived so they can react and have better and more aggressive replies to the challenge. So if you look at the replies, and again, I will not go in detail, but it's very simple. People are complaining that Chinese companies are not very professional on their process and their approach to global dynamics. And on the one hand, they are happy because they think, well, we're going to get more money. But on the other hand, they are very concerned about the capacity of the Chinese company to really react quickly and professionally on this process. And also, almost everybody is extremely concerned now about government approvals, and that's reflected on the fact that I would say 90% of the deals we are doing now, on SPA, we have to pay guarantee, like 10-15% prepayment if you want to have into SPA negotiations. In the past, that was maybe, 10% of the deals. Now it's 90% of the deals. So I think that there is a big concern about approval process as well. So I think that for companies doing outbound into Europe, I think that some recommendations, I'll finish with this. Reliable information. I think that there is a lot of information in the West that can be structured and channeled to help you to make a good offer and a good analysis. Managing the Western target, I think that there is a very important thing. It's like in China, personal relationships are very important. In Europe, it's the same. If you want to buy, you need to go and fly, and you need to do a lot of FaceTime. Many Chinese companies want to do outbound by email or written papers or phone calls, but maybe just they go once before SPI to take a look. So I think that a more personal approach is recommended. And I think transaction process management, valuation, and negotiations, I mean, M&A is normal process. There is a well-traded process that everybody understands. I think that they don't try to break it, just follow it. And again, deal structuring, I think that you need to get a very good advice by lawyers and all that to understand taxations and be competitive. Good. So I hope this was interesting, and if you have any question, yeah, please ask.
Any questions?
Okay. Thank you very much.
All right.